If you woke up this morning and checked the Treasury market, you witnessed a crime scene. You saw the financial equivalent of Julius Caesar looking up at Brutus holding the knife. You saw an ally plunge a blade into the back of the United States dollar. And the weapon, $1.2 trillion in U.S. debt being dumped onto the market by Japan. Not China, not Russia, not some rogue nation we sanctioned. Japan, the country we rebuilt after World War II, the country we protect with our Pacific Fleet, the country that is supposedly our closest ally in Asia. They just began the largest coordinated sell-off of American debt in modern history. And the mainstream media is calling it a currency intervention. That is a lie. It is a survival mechanism. It is a forced liquidation, and it is the beginning of the end of the Treasury market as we know it. Let me paint you the crime scene. On January 6, 2026, at exactly 8:47 p.m. Eastern Standard Time, the Bank of Japan issued a statement, not a press conference, not a televised announcement, a PDF statement released on their website in Japanese with a delayed English translation. The statement said they were exploring options to stabilize the yen. That is central bank code. That is the language they use right before they light the markets on fire. Within 90 minutes, the overnight Treasury futures market in Chicago began to crater, not drift lower, not sell off gradually, crater. The ALOS detected the liquidity shift before any human analyst on CNBC even read the statement. By 11:15 p.m., the 10-year Treasury yield had spiked 42 basis points. That is not normal volatility. That is a gamma flip. That is what happens when a major holder stops buying and starts dumping. And here is what they are not telling you on Bloomberg. Japan holds $1.1 trillion in U.S. Treasuries as of December 2025. That makes them the largest foreign holder of American debt, bigger than China. China has been slowly reducing their positions since 2022. They are down to $800 billion. But Japan kept buying. Japan kept supporting the auctions. Japan kept recycling their trade surplus into treasuries because that is what allies do. That is what the post-1945 financial architecture was built on. We defend them militarily, they fund our deficit. It is a deal, and that deal just got ripped up and thrown in the garbage. Now, before we go any further, I need you to understand something. The algorithm is trying to bury this video as we speak. YouTube does not want this information on the front page because it contradicts the soft landing narrative that Powell is selling. You need to smash the like button right now, not later, not after you finish watching, right now. Because if this video does not break through the suppression filter in the first 30 minutes, it gets shadow banned into oblivion and nobody sees the data. Do not let them silence this. Hit the like button and force this onto the public feed. Let me show you the math because the numbers are absolutely insane. Japan's currency, the yen, has been in free fall since the Federal Reserve started hiking rates in 2022. In January 2021, one US dollar bought you 103 yen, normal range, stable. By October 2022, $1 bought you 152 yen. That is a 47% collapse in 21 months. The Bank of Japan tried to hold the line. They spent $62 billion in September 2022 trying to defend the currency. It did not work. The yen kept falling. By December 2024, we were back at 157 yen per dollar. And now in January 2026, we just spiked to 161. That is a new multi-dead low. That is a currency in crisis. And here's why this matters. Japan is the world's third largest economy. They import everything. Oil, natural gas, food, raw materials, all priced in dollars. When the yen collapses, their import costs explode. Inflation goes parabolic. The public panics. And the Bank of Japan has exactly two choices. They can raise interest rates to defend the currency, or they can sell their dollar reserves to buy yen and prop up the exchange rate. But here's the problem. If they raise rates, they collapse their own economy. Japan's debt to GDP ratio is 264%. That is the highest in the developed world. Their government cannot afford higher rates. It would trigger a sovereign debt spiral. So they have to sell dollars. They have to dump treasuries. And that is exactly what is happening right now. Let me walk you through the mechanics, because this is where it gets ugly. Japan does not just hold treasuries in a vault. They hold them as collateral in the repo market. They rehypothecate them to fund their own banking system. When they sell treasuries, they are pulling collateral out of the global financial plumbing. That creates a liquidity cascade. The algos detect the collateral withdrawal. They fronter run the next seller. The gamma flips. The V-shock accelerates. And suddenly, the entire treasury market is pricing in forced liquidation instead of orderly auctions. And the data proves this is already happening. Let me show you the smoking gun. On January 3rd, 2026, the U.S. Treasury held a 10-year note auction. Standard issuance, $17 billion. The bid-to-cover ratio came in at 2.18. That is weak. That is below the 12-month average of 2.4. The indirect bidder participation, which is mostly foreign central banks, came in at 54%. That is the lowest since March 2020. Translation: foreign buyers are stepping away from the auctions. And the primary dealers, the big banks that are required to buy whatever does not get sold, they got stuck with the remainder. And those banks do not want to hold long-duration treasuries in a rising rate environment. So they immediately hedge by shorting the futures. And that shorting pressure feeds into the algo selling. It is a doom loop. Now, let me contrast this with what China has been doing, because this is the geopolitical angle that nobody is talking about. China has been quietly reducing their treasury holdings since 2022. They went from 1.1 trillion down to 800 billion. But they did it slowly. They did it over 3 years. They reinvested the proceeds into gold and commodities and BRICS infrastructure projects. It was strategic. It was calculated. Japan does not have that luxury. Japan is being forced to sell in size and in a compressed time window because their currency is collapsing in real time. This is not a strategic pivot. This is a financial emergency. And here's the part that should terrify you. If Japan sells 1.2 trillion in treasuries over the next 12 months, somebody has to buy them. The Federal Reserve is not buying. They are doing quantitative tightening. They are shrinking the balance sheet. The European Central Bank is not buying. They have their own sovereign debt crisis with Italian spreads blowing out. China is not buying. They're selling. So who is left? Domestic buyers, U.S. pension funds, U.S. insurance companies, U.S. retail investors. They will only buy if the yield is high enough to compensate for the risk. That means yields have to go higher, a lot higher. Phase 1 is what we are in right now, quiet selling. Japan reduces their treasury holdings by 50 to 100 billion over the next quarter. The market absorbs it, but yields drift higher. The media ignores it. Phase 2 is when the selling accelerates. Japan dumps 200 billion in a single month. Yields spike. The ALOs panic. Volatility explodes. The VIX goes from 15 to 35. Phase 3 is when the feedback loop becomes obvious to everyone. The forced liquidation accelerates. Primary dealers can no longer absorb the supply. Margin calls cascade through the banking system. Hedge funds and leveraged players start unwinding positions. At this point, the treasury market is no longer orderly. The algos are fully engaged. The gamma flips are happening continuously. The price discovery mechanism breaks down, spreads widen, liquidity disappears in the off-run securities. Phase 4 is when the Fed is forced to intervene. They can either buy treasuries to cap yields or let the market run. Either choice triggers chaos elsewhere. If they buy, they restart quantitative easing and undermine the dollar. If they don't buy, yields spike further, credit markets freeze, and mortgage rates soar. Phase 5 is the contagion phase. Foreign holders observe Japan's actions and begin to reassess risk. South Korea, Taiwan, the UK, all start considering exit strategies. This creates a global liquidity cascade. The safe haven status of U.S. treasuries is questioned. Phase 6 is the systemic crisis. Japanese banks face solvency stress due to their foreign exposures. Sovereign debt concerns amplify. Cross-border financial linkages transmit shocks across Europe and Asia. The Federal Reserve, having already exhausted most of its ammunition during COVID, cannot stabilize the system easily. Phase 7 is the aftermath. Market participants reassess risk models. Inflation expectations become unanchored. Bond yields spike across the curve. Portfolio allocations shift abruptly from bonds to other assets. The 60-40 stock bond portfolio paradigm is broken. This is not speculation. This is mechanics. This is history repeating itself with Japan replacing Thailand, and the global financial plumbing is being tested in real time. You need to be aware. You need to watch the treasury market closely. You need to observe foreign ETF flows. You need to check your brokerage account yields. The mainstream narrative is curated. The data you see on TV is sanitized. This is a slow motion crisis. And the Japanese selling has just started. The treasury auctions are just starting to show weakness. The bid to cover ratios are just starting to deteriorate. The ALOS are just starting to position for the gamma flip. And yet, the media continues to insist everything is fine. This is not normal volatility. This is not a market under control. This is the beginning of a multi-month, possibly multi-year crisis that will reshape the global bond market. And every American investor is impacted. The media covers it, but frames it as bond market volatility without explaining the cause. Phase 3 is when other foreign holders join the selling. South Korea reduces their position. Taiwan reduces their position. The UK reduces their position. Now you have 500 billion in coordinated foreign selling. The treasury market breaks. Yields on the 10-year hit 5.5%. Mortgage rates hit 8.5%. The housing market freezes. The credit market freezes. The Fed is forced to intervene. And phase 4 is when the Fed restarts QE and admits that the treasury market cannot function without central bank support. That is the endgame. That is when the dollar loses its reserve currency status. Not through some formal announcement, but through market action. Foreign central banks stop recycling their surpluses into treasuries. They buy gold, they buy commodities. They build BRICS payment systems to bypass the dollar. And the U.S. is left funding a $2 trillion deficit with domestic buyers who demand higher and higher yields. That is debt monetization. That is the Weimar playbook. That is the endgame for every empire that debases its currency to fund its deficits. Let me give you the Brazil comparison, because this is what happens when a country loses control of its currency markets. In the 1980s, Brazil had chronic inflation because they kept printing money to fund government spending. By 1990, inflation hit 2,900%. The currency became worthless. People stopped accepting it. They switched to dollars. They switched to hard assets. The government lost control. They had to create a new currency, the real, in 1994, and peg it to the dollar to restore confidence. It took a decade to stabilize, and that was a mid-tier economy. Imagine what happens if the United States, the issuer of the global reserve currency, goes through a similar crisis. There is no higher authority to peg to. There is no IMF bailout big enough. There is no lender of last resort for the lender of last resort. And this is why the Japanese selling is so significant. It is not just about $1 trillion in treasuries. It is about the signal it sends. It is about the precedent it sets. If Japan, the most loyal U.S. ally in the post-war era, is forced to dump treasuries to save their currency, what does that tell China? What does that tell the Saudis? What does that tell every other foreign holder? It tells them that the treasury market is not the safe haven anymore. It tells them that U.S. fiscal policy is out of control. It tells them that the Federal Reserve is trapped between inflation and deflation with no good options. And it tells them to start planning their exit. Now, let me show you what the smart money is doing, because this is the part that the retail investor does not see. The hedge funds are shorting long-duration treasuries. They are buying TBT, the double inverse 20-year treasury ETF. They are buying puts on TLT. They are positioning for a gamma flip, where yields spike and bond prices collapse. The sovereign wealth funds are rotating out of treasuries and into gold. The data shows that central bank gold purchases hit a record in 2023 and 2024, over 1,000 metric tons per year. That is double the historical average. They are not buying gold because they love shiny metal. They are buying gold because they do not trust the dollar anymore. They do not trust the treasury market anymore. They are diversifying their reserves away from dollar-denominated assets. And the really sophisticated players are buying physical silver because silver is the most undervalued asset in the monetary metals complex. The gold to silver ratio is currently sitting at 88. 1, the historical average is 60. 1, during monetary crises, that ratio compresses to 15.1. If we revert to even a 60.1 ratio, silver has to double stays flat. If we go to a crisis ratio of 15:1, silver goes up 6 times. And unlike gold, which is mostly a monetary metal, silver has industrial demand. Solar panels, electric vehicles, 5G infrastructure, defense applications. The U.S. military cannot build missiles without silver. The deficit between mine supply and total demand is 200 million ounces per year. The deficit is being filled by above-ground stockpiles, and those stockpiles are shrinking. At some point, there's no more inventory to draw from, and the price has to spike to ration demand. But you cannot buy silver at the COMEX price. You cannot buy gold at the COMEX price. Go to your local dealer right now and ask them what they are charging for Silver Eagles or Gold Eagles. The premium over spot is $4 to $6 for silver. The premium over spot is $80 to $100 for gold. That is the spread between the paper price and the physical reality. The COMEX is a price discovery mechanism for paper contracts. This is the hidden physical dollar hegemony. Only 1% of the United States gets to export its monetary policy. The price on the screen has nothing to do with the actual supply. When the Fed hikes, emerging markets suffer, asset bubbles inflate globally, and countries like Japan, who are deep in the dollar system, do not have independent monetary policy anymore. They are vassals. When the yen collapses, when the empire's monetary policy conflicts with the vassal's survival, the vassal has to choose. Tokyo, Japan, is choosing. They are choosing their currency over their treasury holdings. It is a paper market, and that choice has consequences for every American who thinks their 401k is safe in a 60-40 stock bond portfolio. The IMF had to step in to reflect the physical, but the real damage was not in Asia. The real damage was in the U.S. hedge fund industry, long-term capital management, the most sophisticated hedge fund at the time. They had massive positions in emerging market debt. Japanese interest rates are going to create a liquidity crisis. When those spreads blew out during the crisis, LTCM lost $446 billion in 4 months. They were about to default on hundreds of billions in derivative contracts. But the COMEX might, the Federal Reserve, had to organize a private sector bailout to prevent a systemic collapse, and that crisis started with a single currency in Thailand. Right now, tell me what you're looking for. Imagine what happens if the crisis starts with Japan. Japan is the third largest economy in the world. Japanese banks hold trillions in prosper claims. Japanese institutions are deeply embedded in the global financial system. The COMEX price is flat. If Japan's currency crisis escalates into a sovereign debt crisis or a banking crisis, the contagion will make 1997 look like a warm-up. Let me walk you through the reserves, because this is how the same tools. The next crisis is going to require even more intervention, which means more currency debasement, which means more inflation, which means more desperation from foreign central banks who are holding depreciating dollars. The whole system is not enough to sell, and we are in the early innings of Japan's currency crisis. Japanese selling has just started. Japanese institutions, the treasury auctions are just starting to show weakness. The bid to cover ratios are just starting to deteriorate. The treasury market, the algos are just starting to position for the gamma flip. And the mainstream media is still telling you that everything is fine, that this is just normal volatility. Dig it out of the ground, everything under control. And the production is in. The mines cannot just double their output overnight. It takes years to bring price up. I want you to understand something. I do not know how long this channel stays up. YouTube does not like videos that contradict the official narrative. They do not like content that tells people to prepare for a financial crisis. They want you watching cat videos and consumption propaganda. You need to be subscribed with notifications turned on if you want to get the alert before the banks close the doors. Because when this crisis goes kinetic, when the forced liquidations accelerate, when the margin calls start cascading through the system, you will not have time to react. If you are waiting for CNBC to tell you what to do, you have to be ahead of the curve. You need to be subscribed to this channel so you get the data in real time. Click the subscribe button and turn on the bell. Imagine what happens when the treasury market is still the hidden alternative. The United States tie this all together because the big picture monetary policy is being forced to sell treasuries to defend the yen. Selling is going to put pressure on emerging markets. When the Fed cuts, asset bubbles inflate globally. Countries like Japan, who are deep in the dollar system, do not have independent monetary policy. The market disconnects from the paper market, and anyone who's prepared by holding physical. When the empire's monetary policy conflicts with the vassal's survival, the vassal has to choose. And Japan is choosing survival. They are choosing their currency over their treasury holdings. That choice has consequences for every American who thinks their 401k is safe in a 60-40 stock bond portfolio. Let me give you another historical parallel. In 1997, the Asian financial crisis started when Thailand floated the baht. The contagion spread to Indonesia, South Korea, Malaysia. The IMF had to step in with bailouts. But the real damage was not in Asia. The real damage was in the U.S. hedge fund industry, long-term capital management, the most sophisticated hedge fund in the world at the time. They had massive positions in emerging market debt and interest rate spreads. When those spreads blew out during the crisis, LTCM lost $6 billion in 4 months. Catastrophic. They were about to default on hundreds of billions in derivative contracts. The Federal Reserve had to organize a private sector bailout to prevent a systemic collapse. And that crisis started with a single currency in Thailand. Imagine what happens if the crisis starts with Japan.